to the first video of PWM's Expert Series, sponsored by SGPB Hambros. And with me today, I have the bank's Chief Investment Officer, Eric Verleyen. Welcome back to the FT Studios, Eric.
Good afternoon, Yuri.
We'll be discussing investment themes for the year ahead. And I'd like to ask you, Eric, just how much of your bank's current thinking around asset allocation is governed by policy decisions, particularly from the US, where monetary policy is said to be entering a multi-year tightening phase?
This is a very interesting question, Yuri. Of course, the central bank are now turning into a more restrictive, we could say, way of managing the monetary policy. I think the first thing we need to ask ourselves to answer to this question is, why are they raising rates, or why is the US going to start or have started tapering, actually? As you know, the US economy is doing quite well. The growth for 2014 will be 2.9%. This is impressive. The corporate side is doing very well, and we expect to see some pickup in the investment. The consumer, the US consumer, has benefited from the wealth effect. As you know, the wealth effect is the fact that the US consumers is exposed in a way to the equity market with his portfolio and its investments. Market did very well, so they benefited from this. They also own some houses, real estate, and the housing market did also very well. So as a matter of fact, they had a positive wealth effect of 0.7% last year, and we expect to see this effect to be 0.5% for 2014. So here again, some very positive news, which will actually push the Fed to do this famous tapering. So how is it going to work? We expect to see a tapering of $10 billion after each Fed meeting. But should the situation actually continue to improve in the US, and especially on the employment side, they might actually adopt a faster pace. And in that case, it would be 15 billion. So yes, tapering will happen. But yes, it is linked to a very solid and a strong growth in the United States. And we think actually the US will be able to absorb this. And we're still confident on the US economy and on US markets.
So with these economic considerations in the background, if we look at the most basic but often most demanding decision in portfolio management, how much of the portfolio do we put into bonds and how much into equities? How would you answer that question and address this kind of problem?
Yeah, I think it is very important to know that bonds are not reacting in the way they used to react in the past. And we've seen very recently, over the last months, that there was a huge correlation between government bonds and equity, actually. So the premium, in a way, you were paying to get some diversification when you invested in bonds is not justified in a way now. So how do you get some income? This is the question you need to ask yourself. So we've been looking at a lot of products and investment themes, such as the infrastructures business, which is able to deliver some income. That's a way also to get this income part of your portfolio without taking too much risk in terms of volatility. Or we have also been active in investing in some hybrid bonds from banks. We think this is definitely a good investment for at this stage of the economic cycle. So I would say very few bonds, but some other assets yielding and delivering some income.
And what about the high yield bonds?
Among the bond sector, actually, and our bond allocation, we continue to favor high yield. We think there's still value there. On the investment grade side, we think now it's too expensive. So we'll focus on companies where we think there is still some value, meaning that we think that the spread could actually continue to diminish. We don't expect a big pickups in terms of the default rate at this stage of the economy we are in now. So yes, it's still a good investment, especially in Europe, maybe, where people have still been cautious, I would say.
And those investors who are looking to go back into the mortgage-backed bonds, are they maybe a bit premature?
We don't invest for the moment on mortgage-backed securities, but what we've seen is some new players actually which are directly lending some money to investors, and those firms are actually quite successful because banks, as you know, are still deleveraging their book.